In this Track and Trade Pro trading training video, I want to talk to you about orders. Now, I have a little bit different theory on market entry than other people. So know and realize that when you listen to me talk, you listen to the theory as Land Turner sees it. And that when you listen to somebody else talk, they may give you a different theory. Now, I will go through and tell you what some of these other people say, and then I'll tell you why I believe why you should do it, or why I do it my way. I'm not going to tell you how you should do it. All I'm going to do is tell you how I do it, and then you can decide for yourself how you should do it. Now, let's first of all talk a little bit about orders. In Track and Trade, being a trade simulator, the software has the ability of simulating most of the market orders that you can, most orders that you can get on any exchange, and it also has the ability of simulating orders that you can't get on some exchanges and requires a full-service broker to accommodate you with. But that's okay. That's what a full-service broker is for. It depends on the different trading platforms. If you're trading electronically, on what you have available to you. It also depends on whether you're using a full-service broker or a trading platform on what you can and can't do with your order style. Now, most of the stuff that I talk about, I'm talking about using a full-service broker, because if a full-service broker doesn't have the ability of doing the order automated, they will do it manually for you. And that's the nature of having a full-service broker and the advantages thereof. So we're going to go through some of these scenarios. But first thing I want to do is I want to talk about different types of orders and how you can find out in Track and Trade what those different types of orders are and how they're used. So let's go through, and the first thing we want to do is to get to the order help menu. All we do is we come up here and we click on the buy sell tool, and we can place an order on the screen. And when we get the order placement dialog that you see popped up here in the screen, you'll notice that when we go to place an order, we have this order dialog box. And now it's going to come up, and the very first thing that you see is where it comes in and says brokerage fee this date, or this trade. Now this is for each trade. This is not a round turn. You know, you go to your broker, any broker that you might have, and you say, what is my brokerage fee? They generally will quote those to you in what they call a round turn. The word round turn means that they are going to quote you how much it costs to get into the market and back out of the market. All right? So Track and Trade only does this on one side, though. At each time you get into the market, we're going to charge you $14. Each time you get out of the market, we're going to charge you another $14. So the round turn on this example that we're seeing here would be a $28 round turn. All right? So 14 in and 14 back out. Now, I'm going to tell you why they do it this way. A brokerage firm will charge you a round turn, and they generally charge you the full amount up front on the first entry. Now, Track and Trade, we do it where we charge you half of it in and half of it out, which is generally a little bit different than what the brokerage firm does. The brokerage firm generally charges you the full amount, the full round turn, on the entry. So they'll charge you the full $28 when you get in and nothing when you get out. The reason they do this is because oftentimes you might be placing an options order. When you place an options order, your order will go to expiration, and there's nothing that you do. You don't get back out when your option expires worthless. So there's no time for them to execute the exiting of the order. That's why they charge the both sides up front. And it also lets you know, it kind of gives you a target as to where you have to be break even as well. But the reason they do that is so they get their money up front, and then if you have an option order that expires worthless, there's nothing that they do to collect the money. There's no execution, but they got their commission, and they collect that on the front end. So that's how brokerage firms do that. So, but Track and Trade does it a little bit differently, and the reason we broke it apart like this is because there are brokerage firms, and they're rare, but they do break them apart and do half on one side and half on the other. And so this accommodates both in that regard. So you can do it both ways. So we come in here and we say our brokerage fee on this trade is $14 in. And then we come in and we got placement detail. Now I placed this one here, 6/19/2006, and you see it's grayed out. You can't change it. That's because over here on the chart, we're a chart trading tool. So everything is seen visually on the chart, and you're placing your little icon on the chart telling us where you want to place the order, so it knows the date is already set by the icon, and the price. And this price right here is 184. That's the price that you set the little triangle for. So we're going to buy 1, and the symbol, of course, is your symbol. PB 2006M is our British pound. Open outcry 2006 June contract. Now this is what I want to concentrate on. Order type, stop. Now we've got these different types of orders. We've got market orders, we've got stop orders, limit orders, market if touched orders, MOC orders, which is market on close, and we got MOO orders, which is market on open. So they are really just about what they sound like. If you think about it, market order means that I want to get into the price or into the market immediately at whatever the current price is. All right. Now, track and trade is an end-of-day application, so all orders are placed after the market has closed for the day. So these orders will take place on the following morning, all right, or the following day. So you're going to have several of them that will do the same thing for you. The first one is a market order. A market order means get me in as soon as possible at the best price possible, at the first fill that you can. So if that happens, you place your order after the market is closed today, it's going to get you in the first thing in the morning, which is going to be what? It's going to be the open of the market, right? So market on open is going to be the same thing as a market order. It's going to react exactly the same way in track and trade and probably in the real markets. And so track and trade does its very best possible to mimic the rules that are set by the exchanges. So in this case, if you place an order during the day and you say, I want a market order, it's going to go to the market during the day and it's going to place your order immediately, and you're going to get the price at the current price, the best price that they can, or the first price that they can get your order filled at. Market on open would be, if you place it during the day, they're going to wait until the following day, right? And then they're going to place it and you're going to get filled on the following morning's open. Now we have market on close. Market on close is exactly what it says. Fill me on the close. Now, when you're in the exchanges and you're down on the floor and you're yelling and screaming back and forth prices, they have an opening range and they'll have a closing range, and then they have the day's trading. So let's talk about that for a second and how an actual market tick is designed. During the day, or when you have a tick, let's talk about a market day. Let's move this out of the way so we can have a drawing sheet. Okay, we have an open, high, low, close bar. This is the open. This is the close. All right, and that's what it looks like. This point here, of course, is the high of the day. So as the market actually moves through time, and it starts out in the morning, it moves through time, right? Market goes up and down and up and down and up and down, and then it closes. So at that point, we draw this using a tick. This is the high of the day. This is the high of the day. This is the low of the day, right here. And this is the open of the day, or the price that it opened. And this is the close of the day. So we have the open, high, low, and the close. Now this might seem rather simple to you. It's the basics of what we're looking at on a chart. But what you may not know is that the opening and closing are actually a range. And if we had accuracy, if we could look at this a little bit more accurately, it would probably look something more like this. And if I could draw my little line straight, but you get the point, they would actually look something like this. Because in the morning, when the market opens, they have about a 5-minute time frame, which they call the open. Because think about it. What's going on down on the floor? There's several hundred guys standing down in a pit, right? And as soon as the market opens, the bell rings, ding, 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 ding. What happens? You think one guy stands up and says, "Excuse me, I think I would like to buy the British pound for $2.10. Would anybody like to trade with me?" No. We do not have one guy saying, "I would like to buy at $2.10, and one guy saying, "I would like to sell at $2.10. Oh, that's a happy medium. Let's call that the open of the day." No, we have 200 guys. Suddenly the bell rings, and they're all yelling at each other, "Buy, buy, sell, sell, buy." You think they're all at the same price? No, they're not. They're not all at the same price. So you have what we call the opening range. Okay, and for the first 5 minutes of trading, you have all of these guys, 200 guys, 300, 400 guys, plus the whole world, all in there yelling and screaming, buy, buy, sell, sell at different prices. And different transactions are taking place between different buyers and sellers throughout that 5-minute time period. Okay? So we have an opening range. So the exchange will go through and they will say, okay, the price started here and it ended here in the first 5 minutes of trading. Therefore, we take some kind of a rough average or whatever mathematical secret formula that they use to derive that, and they say this is the open for the day. And it actually was an opening range. And then the exchange decided, somehow they decided what they wanted to be the opening numbers. All right? And then on the close, they do the same thing. When the market comes down to about 5 minutes before the market's ready to close. Now, if any of you have been in Chicago and you've stood over the visitor's window and you've watched, 5 minutes before the market's close, they go into the closing range. And the market goes crazy. It goes nuts during the close of the market, because everyone's who's a day trader, of course, is trying to exit their positions before the market closes. And that's what these market on close orders are for, to get out of the market so they don't have to carry their positions overnight. So the market goes crazy. And do you think they've got one guy standing there and saying, I'm the very last person to make a trade today, and I'm going to make that trade at 2:03. Therefore, the close will be 2:03. No. They have 200 guys all yelling and screaming at each other, writing little notes on pieces of paper, making bids and offers, and taking bids and offers at the very close, and they're all different. And so it ends up becoming what they call the closing range. And then the exchange somehow goes in and decides, well, you know what, it looks like on average, or whatever they use, their little secret formula, they derive the closing range, the closing price, and they just say that's what the close is for today. So when you do a market on open, you may be filled sometime within that first 5-minute range at some price. You may not get the exact price that comes through from track and trade. Now, we get that once in a while. I placed a market on open, and I was filled at 2:06, but yet your software says that the open was 2:10. Now, why was I filled at 2:06 when your software said 2:10? Your software is wrong. No, our software's not wrong. What happens is you have that range, and you got filled somewhere within that range on the open within the first 5 minutes of trading. And then the exchange said, on average, this is where most of the trades took place, so arbitrarily we'll call this the open. So just because you put a market on open and you got filled in the market differently than what the software open says that you should have got filled, doesn't mean you didn't get filled at the open, or it doesn't mean that the software is wrong. It means that there was a lot of orders that were filled within a certain range, and we just took an average of them and said that's the open or the close. All right? So let's go back to our example here where we got the chart, and let's pull up our order dialog box and look through it again. So we got back down here. Now we understand what market order is, right? Market order means, of course, immediately fill it at the best price possible throughout the day, as long as the market's going. If the market's already closed and you place a market order, either electronically or with your broker, it's going to be treated the same as a market on open, which would be the following morning. So we've got those three out of the way: market on open, market on close, and market.